Okay, so welcome everyone to the exam masterclass for FINM7322. My name is Claudia De Rocha and I am taking the session today as I've done for the past two sessions. So focus today is going to be on just the key learning units for the exam. For your exam, it is all learning units, so 1 to 7. However, we are only going to cover the most necessary items. Also, I'm just going to ask that everyone please mute themselves when they come in. I am muting individuals, but it is, yeah, it can just be a little bit frustrating there. All right, cool. So, as I said, exam is learning units 1 to 7. I am only going to cover learning units 5 to 7 today, which is the most critical sections that are needed to know for the exam. It doesn't mean that you mustn't recap or go through learning units 1 to 4, which you can use the previous two master classes to help you with that. But for the exam, obviously 5, 6, and 7 have not been tested as yet, so the likelihood of them coming up is very high. So here we have the overview for the masterclass. We've got learning 5, 6, and 7. So in learning 5, we have accounts payable management, we have unsecured sources of short-term financing, and we have secured sources of short-term financing. I will unpack what is under each of these so that you can revise that. Learning unit 6, we're looking at leases, we're looking at options, we're looking at share purchase warrants and convertible financial instruments. And then with learning unit 7, we are looking at mergers. Right. So in my slide deck today is slightly different to the previous master classes in that I have noted what are the key areas under each topic and then gone into the formulas. So for accounts payable management coming out of learning unit 5, there are really two topics that can be asked. We've got the change in credit terms and we've got a cost of giving up a discount. So when we talk about a change in credit terms, this is when our supplier either wants to give us a bulk discount or wants to change the terms of our arrangement, and we have to assess whether it's a viable option or not. Then with the cost of giving up the discount, this is where we determine whether we should forego getting an early settlement discount, or whether we should try and get the early settlement discount. So there is formulas there. Okay, so to start off with our first formula, or first set of formula, it is the change in credit terms. Okay, so what is quite critical when we're dealing with accounts payable and the change in credit terms, that if there is a change in credit terms question, we are actually looking at inventory. Okay, so what I mean by that is we have to calculate the cost of inventory. Okay, so this IC is for inventory cost, and we have to calculate for 3 items depending on the question. So PC is your purchase cost, how much it costs to buy the items. TCI is your total cost of inventory, which you would have learned in learning unit 4. So we're just bringing that in here. That's me. And then, we have our safety stock carrying cost. So some questions will have safety stock, some questions may not. You have to read the question. If there's safety stock, then we do include the piece around safety stock. If there's no safety stock, we don't include it. Okay, and if we were to break down this formula, we have TCI being OC plus CC, OC being the order cost, CC being the carrying cost or holding cost. If we break these down further, your ordering cost is calculated by saying C times S over Q, C being your cost per order, S being your annual demand, Q being your order quantity. And then if we go to the carrying cost, it's your carrying cost per unit times the quantity divided by 2. Okay. Then with your safety stock, It's our standard safety stock formula that we would have covered in the previous masterclass. So our days of safety stock held times your annual usage. That is what we learned in Learning Unit 4, times our carrying cost. Okay, so it's important that we do include the safety stock. I will be doing a question today that covers change in credit terms, and there we will go through how we will tackle this with safety stock. Right. The second formula that we need to know is the cost of giving up your discount. So is your cost of giving up discount is equal to D divided by 1 minus D times 365 over N, where D is your cash discount percentage. So you take your cash discount percentage and you place it into a decimal format and then say 1 minus D. And then we times 365. N is the different is your total credit period less your discount period. Total credit period being the time you're allowed to pay for the debt. Discount period is the how many days you would get the discount for. Okay. Then we have the approximate cost of giving up the discount. So it's very similar to your cost of giving up your discount, but we're saying D times 365 over N. So we take away the 1 minus D. As the name says, your approximate cost of giving up the discount is an approximate cost. So it's not 100% accurate, whereas the cost of giving up the discount is your true or most accurate cost. If you're given a question and they don't specify to do a cost of giving up discount or the approximate one, do both. Okay. If you need to make a decision, understanding whether you should give up the discount or not, then use your cost of giving up the discount because that is the more accurate one. Okay, so we're still in Learning Unit 5, unsecured sources of short-term financing. And there are two areas where we have formulas. We have interest paid on maturity and interest paid in advance. Okay, interest paid on maturity is in essence the end mode if we want to talk to our financial calculators. Interest paid in advance is the begin mode, so at the beginning of a year. And we have certain formulas that we need to understand and remember for to apply or understand this. Okay, so the first formula that we have is interest paid on maturity. So interest paid on maturity, there are two formulas. It's your ER, which is your effective rate, is equal to your interest amount over your amount borrowed. Okay, then we have our EAR, which is our effective annual rate, which is 1 minus the ER to the power of n minus 1. Okay, in your textbook, you will note that the ER is written as R over M, which is your required rate over your compounding period. But I have swapped this out with ER because in essence, if you are asked to calculate the effective annual rate, you will need to take the answer here and plug it into this bracket. Okay, so I have just shifted that. It means the same thing. So if I say effective rate, it's the same as saying our required rate over the compounding period. Okay, then we have interest paid in advance. Okay, so your interest paid in advance, the only difference is between the interest paid in advance and your interest paid on maturity is that we deduct the interest amount from the amount borrowed. Okay, so ER is equal to IA over AB minus IA when we're talking about interest paid in advance. When you are talking about interest paid on maturity, it's IA divided by AB. And the EAR stays the same. That does not change in terms of the formula. But obviously, you will then take your new value, your ER, and place it here and calculate. Okay. When I'm talking about interest amount here, I'm not only talking about pure interest. It means any cost associated with the loan that you're taking out of the financing, right? So remember, this is for unsecured financing. So it can be interest. It can also be admin costs. It can be other costs associated with you having the financing. So please, if you get a question where they've got an other cost, we must add it all together for the interest amount. Okay. And then we have secured sources of short-term financing. We've just done the unsecured. This is now the secured sources of short-term financing. Again, we're still in Learning Unit 5, right? So the 3 types of short-term financing that we have is pledging, we have factoring, and we have loans, okay? When I say pledge, basically I'm saying I have assets, underlying assets that I can put towards it, and there's an assessment that is done as to whether or not those assets will be high enough to get a loan. Okay, factoring is when you sell off your debt to an external company normally, and they go and then collect the debt. Right? Loans are usual loans. These loans here specifically are referring to inventory loans. So there's a section in your Learning Unit 5 where they're talking about different types of inventory loans. So these loans are specific to inventory. Okay, it's important. You must be able to identify in a question what type of financing they're talking to. Because remember, in Learning Unit 4, you would have done accounts receivable financing, okay? And Learning Unit 5, we do accounts payable financing, we do inventory financing as well, right? So we're working through the working capital items. So it means you must be able to identify which working capital items am I working with, which financing is applicable to those ones, and which one's being asked in the question, okay? It's very important, given that we've got now Learning Units 1 to 7 for the exam. Right, so with pledging, there's no formula, okay? There's just steps that we follow. Depending on the question may split up the steps into like question 1.1, question 1.2, question 1.3. You must just read the question. But in essence, if there's no split question 1.1, question 1.2, and they just ask you to determine the level of funds available, you need to follow these 4 steps, which is determine your total accounts receivables or gross accounts receivables, the same thing. Determine your expected losses, and determine your net accounts receivables, and determine the level of funds available. Okay, when we're talking about your total accounts receivable or gross accounts receivable, we have to assess each debt based on the requirements of the bank. Okay, so remember, pledging is I'm getting secured financing. Secured financing means I have collateral. What is collateral? I have some kind of asset to give the bank if I'm not able to pay. Okay, so when you're dealing with your gross accounts receivable, the first step, I'm assessing whether my debt meets the requirements of the bank to get the loan. Okay, an important step. Step 2, expected losses. So with most debt, you do expect there to be bad debts. That's what expected losses is. And we need to take that into account because when we are getting financing from a bank, they will only give an amount equivalent to your accounts receivable that are good. In other words, the ones that you can collect for. Okay. You determine your net accounts receivable is your total accounts receivables less expected loss. And the level of funds available, that is basically an amount calculated based on what the banks are willing to give. So what I mean by that is most banks will not give 100% of your debtor's book. They will give a certain percentage, 80%, 60%, really depends. And we need to factor that in when we are calculating here. Okay, so there's a question from Jordan. Where is this formula in the textbook? Which formula are you talking to, Jordan? Okay, and there's also asked about the difference between 3 formulas and changes in credit terms. Sure. Okay, so I'll go back. Okay, so this formula is not structured like this in the textbook. there isn't a formula written in the textbook that says purchase cost. There is a formula, however, that covers total cost of inventory. That formula is on page, I'll just double check now. It's on page 115 of your textbook, 115. Okay, because it was part of Learning Unit 4. And then this safety stock formula is not specifically in your textbook, but this is how you would tackle it, right? In the question banks or the answers of the textbook, they don't structure it as a formula normally. They'll just calculate each piece in a table. In today's, one of the past papers today will cover this. We will go through this formula. My memo follows the formula method, but what I'm going to do today in the video is do it the table method so that you can also understand how it's done in the textbook versus the formula. But in essence, it's following this formula. So it's not in the textbook. It's a combination of different things we have to do to get the answer. Okay. I hope that answers. Okay, so to explain this difference between the three, PC is the purchase cost. This is the total amount that you're paying to purchase the inventory items. Okay. TCI is the total cost of inventory. It's part of the EOQ, Economic Order Quantity Principles, where they're saying that the total cost of inventory has to do with your ordering cost and your carrying cost. Okay. And then the third one is for safety stock. It's your safety stock carrying cost. So the principle is that when you have safety stock, there is a carrying cost because you keep it in your warehouse for a certain amount of time, and therefore you should be taking that into account because you're incurring costs by holding that inventory. Okay. So I'm just going to answer this and then we'll go back to where we were. All right. So let's go back to where we were. Okay, so I went through pledging, right? Okay, now we're in factoring. So with factoring, we are basically selling off our debtors book. Okay, it's a principle that has been covered before. It's not a new concept, factoring. It's just that we have a calculation now. Step one is determine date of remittance, and step two, determine value of what's been remitted. Okay, so it's really two steps. It's really very simple. We literally look at the dates and determine the date of remittance, and then we look at the values. There's no formula. It's a very small section of your textbook. So it's not a complex section. Right, now we need to deal with loans. Okay, so it's different kinds of loans. Either it's the secured loans they give you, or it's the inventory loans, like I said, that exist in Learning Unit 5. Different types of loans. So we have it's the same formula that we would have used previously. So remember I'd shown you before, so I'm just going to go there again. When we do interest paid in advance and when we do interest paid on maturity, we use this formula. ER is equal to IA over AB, and then the EAR. Okay. We use that for unsecured financing, right? Now, when we're coming to secured short-term financing for inventory loans, okay, it's very specific. This is inventory loans. We use the interest paid in advance. That is what we use. Okay, so it's the ER is equal to interest amount over your AB minus your IA. Okay, so it's very important that we understand they're the same formulas. The only difference is this one's being used for loans. I mean, for inventory loans. The other one's so secured financing. The other one's being used for unsecured financing, but it's the same. Okay. Right. Then let's move on to leases. Okay. Leases is part of Learning Unit 6, right? Leases is quite an important section. Okay. Definitely is something that everyone must know. There are no formulas for leases. We need to follow steps and we need to apply the net present value principle that you would have learned last semester. That's also been carried through into this semester. So no specific formulas. So when you're dealing with leases, it's either they will ask you to just evaluate the lease or evaluate the buy or to do both and compare. Okay, so you need to read the question and understand what they are asking you, right? Because with these kind of questions, they can be very time consuming. If you've misunderstood the question and you go do a full-blown lease and buy alternative question, you will run out of time. Okay. If they're just asking for lease, just do the lease. If they're asking just for the buy, just do the buy. That's all that needs to be done. Right. So first step is to determine the after-tax cash flows of your lease alternative. Okay. So we need to work out what are all the cash flows. And when we're dealing with these cash flows, they're normally outflows because we are only dealing with the cost impact. Okay. When we lease, we are only paying. Right. There may be a little bit of an inflow if we sell something, but your cash flows will be negative. Okay. Step 2 is to determine after the cash flows of buy alternative. Again, most of the cash flows will be outputs, so they will be negative, and you will get a negative amount. So when we are working with leases and the decision-making process here, we're trying to understand which option will give me the lowest cost. Where am I spending less? Okay. Then your third step is to determine the net present value of your lease and buy alternatives. So remember, when you're doing NPV, you can use the financial table method, okay, which we did last semester, or you can do the financial calculator method, right? Either way is acceptable. My suggestion is to make sure you can do the calculator method, because if they do give you an interest rate, a cost of capital that is a 0.25 or a 0.3 or a very weird number, it's going to be very difficult to use the tables, okay? Because the tables that are in your paper are based on whole numbers, okay? So my suggestion is definitely use calculator. It's also quicker and more accurate because there's no rounding, right? Okay, then step 4 is to make the lease or buy decision. As I said before, you're looking at the cost. You're looking at which of the two will give you the lowest cost. Okay, still in Learning Unit 6, we have options. Okay, we have call options and put options. Okay, call options are options to buy, put options are options to sell. Okay, make sure you know the difference. Make sure you understand how to calculate. I'll go through the formulas now for you as well. The main piece here is to calculate the gain or loss. Okay. So, formulas. So when we are working with options, the main question that comes up is to evaluate ordinary shares. So what is the gain or loss on the shares? Okay. And then the second part will be what is the gain or loss on the option, right? On the slide deck, I don't have the formula for calculating when we are determining the gain or loss on shares. So I will add that in subsequently. But in essence, it is the proceeds on disposal of your shares less the initial investment. Okay, so I will make sure that that's in here. So when it's distributed, you have that. Most important are these two formulas. So when you're dealing with a call option, it is your share price minus your exercise price. Okay, so there's quite a lot of terminology with options. We have your share price, which is the market price. We have exercise price, which is the price at which you can exercise your options or fulfill the requirements on the options. The other word for exercise price is strike price. Okay, so please make sure you understand exercise price, strike price are the same words or mean the same thing, so they can be used interchangeably. And then we times by the number of shares and we minus the option cost. Okay, if it's a put option, the gain or loss, we swap the exercise price and we say exercise price minus share price times your number of shares minus your original cost. Okay, if you follow these formulas, your result will tell you if it's a gain or loss. You don't have to completely do an analysis to say, oh, it's a call option, it's therefore to buy. Therefore, if I'm going to buy, I want to try get the share price that's higher than my exercise price because that will mean there's a gain because I'm buying cheaply. You don't have to go through the entire thinking process. This will allow you to understand the numbers negative, it's a loss, the numbers are positive, it's a gain. Okay. What must be noted though is that if you get a loss is limited to the cost of the option. Okay, it's very important that you understand that when you enter into options, you cannot have a loss beyond what you spent. Okay, that is one of the benefits of going to options. It minimizes the risk that you take on. Okay. Right, still in learning unit 6, we have share purchase warrants. Okay, so share purchase warrants are basically an instrument that has an underlying asset, normally a share, and there's collateral attached to it. So there's an underlying asset. Okay, and there are three areas where we have formulas. We have the implied price, which is basically the price to purchase the warrants. Then you got the theoretical value of the warrants, what it's worth. So implies what I purchase it at. Theoretical value is what it's worth. Market value is what is the market value or the perception of the market of these warrants. It's important that you also understand these three terms, what they mean, what they represent, so that if you need to analyze your question or the answer to your question, that you're able to do so. Okay, the first set of formulas we have is around the implied price. Remember, the implied price is what you can purchase your warrants for. Okay, so we have two sets of formula, which is the implied price per warrant and the implied price of all warrants. Okay, so your implied price per warrant is your implied price of all warrants divided by your number of warrants per bond. Okay. To get that answer, we then need to go and do the implied price of all warrants, which is your bond price with warrant, because warrants are normally pegged against the bonds, minus your straight value of the bond. Okay, straight value of the bond is your net present value of the bond. Okay, and when we're talking about bonds here, we're talking about corporate bonds. Okay, so please, corporate bonds have been a hot topic for third year finance. It was covered in 3A. It's also covered in 3B. If you go back to learning unit 1, you were asked or should know that to calculate the cost of a corporate bond, okay, we calculate the IRR, right? Here, they're asking us to do the straight value of the bond or the value of the bond, or in other words, the present value of the bond, if you want to say that, if you want to link it to what you learned in learning unit 1, you then calculate the NPV. Okay, it's important because now you're dealing with learning units 1 to 7, we need to be able to identify the difference with the bonds. You can get a corporate bond question where they want you to calculate the cost of the bond, that's your IRR, but you can then get a bond question where they want you to calculate the straight value of the bond, okay? These are two different methods. Okay, so with the theoretical value of your bond, okay, so before I go on, I see there's a question in the chat. It says, would the exercise price used in the profit or loss on the option include the cost paid by the holder? No. So not the exercise price. So if I go back to that formula, your exercise price is just the price that you can basically go forward with the requirements of the option. So an option is basically saying, I'm going to invest in this, and then I can choose to sell it at a point in time based on the price in the contract. Okay. So that's your exercise price. Your original cost is not including the exercise price. That's separate. Okay. Your exercise price is a value. It's not it's a value in the future that we're saying we're expecting this option to be a certain value in the future. I'm going to peg it at X value. Okay. So the original cost is how much you pay for it. The EP is a price of the option, or the price representing the underlying share that the option's pegged against, that we are literally like limiting it. So so options, if I had to summarize, it's options like future telling, right? Basically, you're saying I'm expecting a certain shares to hit a certain value. Okay. If I want to buy them if I think they're going to go higher, I would like to buy them cheaply. So I'll enter it into a contract, and I'll say that in the future, I want that price to be X. That's my exercise price. Okay. And therefore, if I do fulfill the option in the future and my predictions are right, I'm assuming that the price is going to go up, I'm gonna gain because I'm gonna pay less for it. Right. So it's exercise price and the amount you pay at the beginning of the option, two different things. Okay. Alrighty, so let's go back to where we were. We did the implied price of a share warrant, then a theoretical value. So the theoretical value is the value of that warrant. So maybe we paid 100 rands, that's implied price, but maybe it's worth 120. Okay. So that's what the theoretical value of a warrant is, right? And it's this current share price of the underlying share. Remember, I said warrants are based on an underlying asset. Current share price of underlying share minus your warrant exercise price times your number of shares per warrant. Okay, so important that we know this formula, we understand its relation to the implied price, and we're able to apply it. And then with the market value, so when we look at the market value of a warrant, we're looking at the warrant gain or loss, okay? And we're looking at the warrant premium. Okay, and when we look at the warrant premium, we're saying it's the market value of the warrant less the theoretical value of the warrant. So what we're saying is the value. So if we use the theoretical value formula, that will tell us in essence what the value should be of the warrant. But maybe in the market, they're saying the warrant is worth more. The difference is therefore a premium, right? Counterwise as well, which is not here, it could be the other way, which means it's a discount. Okay, so that could also be the case. With your warrant gain or loss, we look at the current share price minus the market value of the warrant, okay, times your number of shares. So basically what we are saying is that if we are to exercise that warrant, we're going to exercise at the share price right now, but then the market value might be different, and therefore we get a gain. So it's the difference between the two. Conversely, if our share price is lower than the market value, then we'll make a loss. Okay, so this formula is set up so that when you get a positive number, it's a gain. When you get a negative number, it's a loss. Okay. Right, then still in Unit 6, we're moving into convertible financial instruments. It's very important. You can either you can have a convertible bond that gets converted into ordinary shares. And what's important is convertible financial instruments only get converted into ordinary shares. Okay. You can also have preference shares, convertible preference shares, and they then get converted into ordinary shares. So you're always converting into ordinary shares. Okay. So these are all the different formulas you need to know. You need to know the conversion ratio, the conversion value, the straight bond value, the market value, and the floor price. Okay. So when we're looking at the conversion ratio, what are we saying? We are saying how many shares can we get for this instrument? So if it's a corporate bond or convertible bond, if I convert it, how many shares do I get? Okay, so the conversion ratio is your par value. So when we talk about par value, it's the same as your share value of the bond divided by your conversion price. Okay, so every convertible instrument can be converted at a price. All right, so this is how we calculate the conversion ratio. Also, this formula can be manipulated so that we have to calculate the conversion price or we have to calculate the par value. So see what the question wants you to do and ensure that you can manipulate. Then we have the conversion value. Okay, so the conversion value is the value of this convertible instrument. So if we convert, what do we get? And the conversion value is your current share price times your conversion ratio. So that portion of that instrument that's convertible, what is that value? Okay, what is it worth? Then we have the straight value of the bond, which is the same straight bond value or straight value of the bond, which we would have done when we did our warrants, right? Because if I go back to warrants, okay, we had here straight value of the bond, right? It's the same principle here. So if we're going into our convertible instruments, our straight value of the bond, okay, we calculate it using our financial calculator. We do a net present value. Okay, we do a net present value from cash flow 0 all the way to the last cash flow. Cash flow 0 is always 0. Cash flow 1 to the cash flow before the last year is the interest amount. When I say interest, it's the coupon amount. Okay, so remember, all this terminology around bonds would have been covered last semester. So if you want to look at those master classes, also it was covered this semester in the previous master classes. Okay, so make sure you understand. When we're talking about a bond, we have face value, par value, which is the basically the amount that you paid for that bond. You then have your coupon rate. Your coupon rate is basically the amount that you need to pay in the interest. Okay, that coupon rate would be the cash flow 1 to cash flow before the last one. And generally speaking, it always needs to be after tax. If your question doesn't have tax, then you keep it as is, but remember it's after tax. If you go back to learning unit 1 of the semester, when we calculated the cost of a corporate bond, we factored in tax. Okay, so please make sure that you don't forget that if it comes up in the question, right? Then your last cash flow for straight bond will be the interest plus the basically amount that you're going to pay, okay, the par value, etc. Okay, then you've got your interest rate because you're using your financial calculator. The interest per year will be the interest rate for an equivalent corporate bond in the market. Okay, and then we NPV, right? If you're using the HP calculator, you're going to go cash flow 0, cash flow 1, etc., etc., etc. Interest per year, and then you're going to go NPV. If you got the Sharp calculator, you're going to do data, because that's your cash flow. You're going to do, arrow to your NPV and enter and compute. Okay, so make sure that you understand how to calculate NPV for your 2 different calculators, depending which one you are using. Right, so with the market value of a convertible financial instrument, it's the higher of your conversion value and your straight value of the bond. Okay, that is your market value. So if you get a question asking you to do that, you must make sure you do the higher of. Right, then we have the floor price. Your floor price is the straight value of the bond. So in other words, what is the minimum value of this bond? Okay, the minimum value of a bond is your straight value of the bond or the net present value or the present value. What is the value now? Okay. So make sure that you also understand that. Right, then mergers. Okay, then in 7. Very simple in terms of concept, but the questions around mergers are super, super, super tricky. Okay. So we are going to do one today that's quite tricky. So it takes into account all different kinds of formulas that we must know. Okay, so first thing with mergers, there's a bit of a process. You value the target company. So if you want to merge with a certain company, you will value that target company. And then once you've decided, yes, I'm happy, I want to merge or acquire this company, then we go into the share swap transactions. Share swap transaction is where we basically exchange shares to purchase. So there's no cash transaction. It's an easy, quick way to finance a merger. Right, so when we do valuing target company, okay, there's no formula. We are basically taking the cash flow of that company and doing the net present value. That is what we are doing. Okay, so you can do it for just assets or you can do it for a going concern, right? And these questions, you need to read what they're saying to you about the cash flow, because they will say to you, the cash flow is 50,000, increases in the following year, whatever it is. You must make sure that you're reading the question. Okay, then first set of formulas is we have our exchange ratio. Okay, so what is our exchange ratio? Our exchange ratio says to us how many shares can we give to get. So we talk about the acquiring company and talk about the target company. So here we're saying, what does the acquiring company need to give the target company in order to merge with them? Okay, so we have PPSTC, which is the price paid per share of the target company. Okay, so that is in essence, the amount you pay for the share of your target company. So this is the company that we are acquiring. Then you have the market price of your acquiring company, okay, which is just what the share price is in the market, right? Then we have pre-merger EPS and post-merger EPS, pre-merger price earnings ratio and post-earnings price earnings ratio. Okay, it's very important. Also, what I haven't noted here is all the other formulas that relate to earnings per share and price earnings. So if you recall in the previous masterclass, I would have gone through all the different formulas that exist. So what I mean by that, dividend per share, dividend payout ratio, you need to know those, okay? It does come up, and you'll see in the question that we're doing today, it comes up, okay? Because remember, again, it's learning unit 1 to 7. Also, in finance, all the learning units flow one into the other. So you cannot treat the learning units in isolation. Things from other learning units can creep up in any question from any learning unit, okay? So your pre-merger EPS is both for the acquiring and target companies. And it is the normal earnings per share formula that you've known ever since your second year. Earnings per share is equal to earnings over your number of shares issued. Okay, there's no difference here. Okay, same with your pre-merger price earnings ratio for both target company and acquiring company. It is the price earnings ratio that you would have known ever since forever when you have been doing finance. Okay, so it's your price earnings ratio equal to share price over your EPS. Okay, remember this one, the PE and the EPS formulas interlink. Okay, can you see here? They both have EPS in them. So it means that one can be used to facilitate the other. Right, then we need to understand the post-merger EPS. Okay, post-merger EPS, we calculate for both the acquiring company and the target company. Okay, when I have MC here, when I say merged company, I'm actually talking about the acquiring company. That is what I'm saying, because the acquiring company, once they've merged with the target company, they are now a merged company. Okay, so this post-merger EPS is for the new company that's been formed, right? And the formula is total earnings divided by your acquiring company shares plus your target company shares times the ER, which is your exchange ratio. Okay. Then you have your target company EPS, which is your merged company EPS times your exchange ratio. So you can see that the formula now is different. Okay. Also with your TE here, it's your total earnings. When I say total earnings, it's your earnings of your acquiring company and your target company together. You add them together. Okay, please, it's important that you know this. Okay, then we got post-merger PE. So your merged company PE and your target company PE. Your merged company PE is your share price of the acquiring company times your exchange ratio divided by the target company earnings per share. Okay. When you're looking at your target company price earnings ratio after merger, it's your share price of your target company divided by the target company EPS. Okay. So you'll see that there is a slight difference to the formula, very slight. Okay. Then we have what we call the market price exchange ratio. Okay. So your market price exchange ratio is your share price of your acquiring company times the exchange ratio. Okay. And then you've got your share price of your target company. Okay, so what you're trying to do now is you're trying to understand what is the exchange ratio of the market. When we first did it before, it was the exchange ratio to say how many shares do I need to give the target company to merge. Now this is in terms of the market. What is the exchange ratio of the market? Okay. Any questions before we move on? Okay, so I see there's a question. Does TE include synergy? Okay, it depends, right? What is the question telling you? Okay, if they're saying that the synergy will impact the earnings, then yes. Okay, but the synergy can also impact the shares, it can impact other things. Okay, so you've got to read the question. The question guides you. And that's the trick with these kinds of questions, especially your merger questions, is that, I mean, even your leases questions, they can literally put anything in the question. They can ask you to calculate in any manner. You need to read the question. You need to understand what are they asking you. Okay, so the synergy, it depends on what are they, where is the impact of the synergy being felt, right? Okay. So normally in my previous master classes, I would have gone to the whiteboard and unpacked the formulas in a bit more detail. Two things, I'm having a couple of issues with the mural, but also because of time, because we've got 3 questions to go through, I do want to move on to the questions and unpacking those in terms of the formula. What I am going to do now is I'm just going to give us a little break because we do have a 3-hour session. So I'm going to give us not a long break, maybe a 5-minute break, come back, and I'm going to start doing the questions. So I've got 3 questions. The first one is on changing credit terms, which is your learning unit 5 question. Second one is on leases, which is your learning unit 6 question. And then I've got mergers, which is your learning unit 7 question. Okay, and in this learning unit 7, there's a bit of learning unit 3 with the dividends and 4. Okay. All right, so I'm just going to be on mute and I'm just going to go off camera 5 minutes. Let's take a short break, then we'll come back and we'll continue with the questions. Okay, everyone, we're gonna continue now. All right, so we're gonna go into our first application question, being change in credit terms. Okay, so we'll just stop sharing my screen for now, and I'll bring up the question as well as somewhere for us to go through and work through the question. Okay, so I'm going to share my screen now, and we can go through this question that's been prepared. All right, so please just confirm that you can see my screen. You should see the past paper question for Learning Unit 5, and you should see the number sheet to note it down. Just please include your thumbs up. Okay, are you able to see? Okay, yeah, there's a hand up. Thank you. You can see it. Great. Thank you so much. All right, so Learning Unit 5 question is out of 30 marks. Okay, so mark allocation is 30. The time for the question, we take the 30 and we times it by 1.8, so 36 minutes. 30 marks, 36 minutes, right? Okay, so question 1.1 says, advise Rodeo Limited whether it would be more beneficial to continue with the current order size or switch to the supplier's bulk order discount offer. Okay, so immediately, before even reading the details of the question, if they're asking you for supplier's discount, we know that we are in Learning Unit 5. We know we're dealing with accounts payable. Because we're dealing with accounts payable, it means that we are in the credit terms section. So if I go up to my list of formulas, we are dealing with this one. That's what we're dealing with. Okay, change in credit terms, and we are trying to calculate the inventory cost. Okay. Right, so question 1.2, calculate the cost of giving up the cash discount and advise Rodeo Limited as to whether they should go ahead and accept the supplier's offer of the early settlement discount. So again, we are still in Unit 5. We are now with these formulas, the cost of giving up your discount. Okay, remember I said, if they don't tell you, use both. But the more accurate one, if you need to compare, because in this question, they're asking you to advise, you would use this one. Okay, the more accurate one. Okay, then question 3 or 1.3, advise Rotary Limited or any two other unsecured source of short-term loans that they could possibly utilize to finance their operations. Okay, so this is theory. They're saying, please advise on other two unsecured sources of short-term loans. Okay, there's different option here, but we'll unpack it when we get there. Right, so let's get to the information. It says Rodeo Limited places orders every 10 days that it operates for 3,500 units of finished goods. The supplier's credit period is currently 50 days. The cost per order is 750 Rand. The cost per unit is 18 Rand, and the current holding cost per unit per annum is 6.50 Rand. The company holds safety stock equivalent to 15 days of operation. Rodeo Limited supplier Texas Limited has offered the company either an early settlement discount or a bulk order discount. The settlement discount will involve the supplier offering the company an early settlement discount of 3.75% and a discount period of 20 days. Okay. The bulk discount will involve the supplier offering the company a bulk purchase discount of 2.50 for order size of 6,000 units or more. If the bulk discount is taken, the holding cost per unit will increase by 20% per annum, as the company will need to seek additional storage facilities to accommodate the larger order sizes. And the company will reduce its current safety stock requirements by 4 days if it accepts a supplier offer. Okay, so remember, when I did the formulas, remember I said to you, and if we go back here, that you have your safety stock. So only if a question mentions safety stock do we then have to factor in safety stock into our question. Okay, this question has safety stock, so we do need to factor that in. Okay, then it says Rodeo Limited has access to short-term financing at a rate of 14.50 per annum. Assume that Rodeo Limited operates for 360 days per year. Okay, so question 1.1, where we have to advise where we have to advise Rodeo Limited. What we are trying to look at is we are comparing the current policy for suppliers versus the proposed policy. Okay. When we're doing the current policy, we are factoring in, like I said, those three costs. So the formula is this one. Okay. So this is the formula. But like I said to you, I am going to structure it so that we do it in a table format, right? You can do formula method or you can do formula method or table method. I'm going to do table method here. And then obviously whatever solution you get from me, it will be a formula method, right? So we have to determine the inventory cost. We have to determine the purchase cost, and we have to determine the total cost of inventory. So if we're doing a table format, okay, we're going to start off with the different items. So we have our purchase cost, which is our PC. And we have our total cost of inventory. We have our purchase cost, which is our PC. Okay, and then we have our safety stock carrying cost. Okay. Okay, so I'll do the calculations, this block, and then here we'll have the amount. And you can see very clearly what's being done. Okay, so with your purchase cost, it is the total cost of your inventory items. Okay, so in this top part, they told us that our cost per unit is 18 Rand. Okay, so we know that we're definitely going to have to say the 18 Rand multiply by. Now we need to understand how many units that we are doing. Okay, based on the question, sorry, just give me a second. Sorry about that. Okay, so right. Okay, so purchase cost, but now we're going to work out how many units we are working with in a year. Okay, based on the question, they told us every 10 days we order 3,500 units. So we now have to work out how many nth days or how many times, that we actually order it. And we have 360 days here. So we're going to times our 360 divided by 10 times the 3,500. Okay. And that will give us the total cost of our inventory items. That is the value. Okay. Now we're going to go to our total cost of inventory. So our total cost of inventory is made up of two things. Okay. Our total cost of inventory is made up, and if I go back to what I had shown you before, okay, it is made up of our ordering cost and our carrying cost. Okay, so we have to make sure that we've got that in here. So with our total cost of inventory, we're going to have our ordering cost and our carrying cost. Okay, with our ordering cost, as per the formula that we did, it is your carrying cost or cost per order, sorry, times your annual demand divided by your quantity. Okay, so that's the formula that I need to worry about. Okay, so I'm just going to put it here so you can see it. And I'll just make sure it's the right size. Okay, so our formula for ordering cost is our cost per order times the annual demand divided by Q. Okay, that is our formula. So then it means that I have to go into this question. I've got to find my cost per order, which is the 750. Okay, so here they said cost per order is 750. Multiply my annual demand. So my annual demand, okay, is going to be the 360 divided by 10 times the 3,500. Okay, because in essence, I need to understand how many units in the year that I've ordered, right? All divided by your quantity, and our quantity is 3,500. So when I talk about quantity, I'm talking about the quantity per order. Okay, please, that's very important. It comes from the principles of EOQ, all of this. Okay, so we need to make sure that we understand that. Let's make it bigger so you can see. Okay, so if we had to just calculate that quickly. We get 27,000. Okay, then we go to our carrying cost. We need to bring in the formula for our carrying cost. So remember we said carrying cost is your carrying cost times your quantity divided by 2. Okay, so that is what we are doing. So that's our formula. So we go to our question. We know that the holding cost, which is the same as carrying cost, is R6.50. We then multiply by the quantity. The quantity here is 3,500. Okay, so remember when I'm saying quantity, I'm talking about order quantity, and I divide by 2. Okay. And I get 11,375. All right. Okay, last one is our safety stock carrying cost. So we have to go back to our formula. So the formula is day safety stock held times our annual usage times your carrying cost. Okay, so our day safety stock is held is the 15 here. Okay, because that's when they said it is. Times our average usage. Okay, when we're looking at our average usage, we're basically saying how many instances do we order? So we're going to say the 3,500 divided by 10. Okay, so it's basically, we're trying to work out the days. Okay, so 305,000, we got 3,500 units. How quickly do they get used up? Okay. Then we've got your carrying cost or your holding cost, which is the 650. Okay. Okay. So when we calculate here, we're going to say our 15 times and we get 34125. Okay, and then we add this all together. Okay, and that gives us the total or inventory cost for the current policy. Okay. Let's now move on to the proposed policy. Okay, so with the proposed policy, it's the same formula. Okay, but we're also gonna do it in table format, and then all we're going to do is we're gonna make adjustments based on what the proposed policy is. Okay, so still the same format. Purchase cost plus your total cost of energy, which is made up of your ordering cost and carrying cost plus your safety stock carrying cost. Okay, so that's all part of it, right? Okay, so with your proposed policy, okay, here, because it's on the bulk discount, okay, so here they're offering a discount of 2.5% for order sizes, cool, and the holding cost will increase by 20%, and the company will need to seek extra storage. So basically, all of this here is relating to this or the current policy, okay, or the proposed policy. So first things first, okay, we're going to do our purchase cost. So our purchase cost was initially the price was 18, but because they're going to give us the discounts, we need to factor that in. Okay, so we're going to, in essence, I'm taking out the 2.5 by timesing it by 97.5%. Okay, and the rest of it stays the same. We're still going for 360 days in a year. We're still doing 10 days. We still got 3,500. That all stays the same. Okay, so when we update this formula, we get 2 to 11,300. Right. Now we're going to our ordering cost. Okay. Ordering cost, we still have the 750. Okay, that did not change. We still have the 360. That did not change. We still have the 10. That did not change. Okay. And we still have the 3,500. That still has not changed. So the current cost, the annual demand is still the same. But what has changed now is that our order size has changed. It's now 6,000 units. So we're going to come here and divide by 6,000. Okay. Because the order size has changed. Remember I said to you the Q is the order size. Let's get 15,750. Right, then we go to our carrying cost. Okay. Carrying cost is still the same. Your quantity is different now. Remember I said your quantity is different. There is also, oh yes, your holding costs will increase by 20% per annum. Okay, so first things first, we have to increase this. We have to increase that. So it's the 650 times the 120. Okay. And then we're going to change this 3,500 to this 6,000 because that is now the new orders, right? Okay, so when we come here, we're going to say 6,500 times 1.20 because we're increasing it. We're then timesing it by the 6 and then dividing that by 2. It gives us our 2,3,400. Okay, now we're going to go into our safety stock. So with the safety stock, okay, they did say to us that the safety stock requirements will reduce by 4 days. Okay, so it means that we're going to say 15 minus 4. Okay, our average usage still stays the same. Our carrying cost has to increase because that's what they told us. Okay, which now means that if I update this calculation, okay, which gives us a 228,480. Okay, so now to answer the question, they're asking whether it would be more beneficial to continue with the current order size or the supplier's bulk order discount. We have to base it on these two answers because we are calculating inventory cost. We need to take the lowest of the two. Okay, so as you can see, it's just our recommendation. Okay, so I'm going to take the proposed policy because it is lower. It's 2280480 versus 2340 500. Any questions there? Okay, perfect. Right, that was question 1.1. Let's go on to question 1.2. Okay, so question 1.2 now is asking us whether we should give up the discount. Okay, so when we're giving up the discount, we have to use the discount formula. Okay, so to remind us, here we go, cost of giving up the discount. So this is the formula that we're going to use. Okay, so if we had to calculate all the pieces, what is our discount percentage? It is the 3.75. Okay, so remember that D is for the discount percentage. So it's this here, it's the discount that we're going to give. Okay, so we're going to say it is equal to, let me actually separate this. Okay, so it's going to equal the discount percentage. And I did say that we need to make sure, this is at a decimal format. Okay, divided by 1 minus, okay, all multiplied by 365 over n. Okay, n basically being, if I go back to my formula, it is the total credit period less the discount period. Okay, our total credit period here is 50 days. Okay, over here. And then our discount period is 20 days. Okay, so if we compute it properly, okay, so the value we get is 0.4, or if we want to convert it into a percentage, it's 44740. Okay. Okay, there we go. Okay, 1.2 and then 1.3 is theory question. You can mention any unsecured sources. So you can say bank loans, overdraft facilities, lines of credit, revolving credit agreements, single payment notes. You can say anything really. All right, so that completes our first question. Any questions on this? Okay, the SEC formula. I see someone's asked. Okay. Any other questions on this one? Okay, great. So we are going to go on to the next question, which is from Learning Unit 6. Okay, before we tackle that one, it's quite a lengthy one. Let's take another 5-minute break, and I'm going to come back and do the second question. Second question should take us into our second hour of the session. And we can then take a break and then finish up with our last one. See you all in 5 minutes. I'll just also note it in the chat. Okay, let's continue. So all of the content should be uploaded by tomorrow, the video, etc. I see there's a question, Rotondwa. So should be by tomorrow. I just need to share everything and then it gets uploaded. So tomorrow definitely will be up. Okay. Creating solutions, etc. But yeah, so the video will be up on the YouTube channel, and then questions and solutions, all that I give to your lecturers to distribute. So if you don't get something, please reach out to your lecturers. I do share it with them so that they can distribute. Okay, so I'm going to bring up the second question now. So just give me some time. Okay, so I'm going to share my screen now. Please confirm that you can see it with the thumbs up, some kind of indication. Anyone? Okay, so I'm assuming everyone can see. I didn't see any thumbs up or anything, but I'm assuming you can. If you have an issue, please let me know, okay? Ah, there. Thank you, Connor, for putting your hand. Appreciate it. All right, so question 2 is a 40-marker learning unit 6 question for leases. Okay, so if it's 40 marks, it's going to take us 48 minutes to complete, or that's what it should take you, or that's the maximum time you have in the exam to complete it. And then let's look at the required. Okay, so it says calculate the after-tax cash flow of the buy alternative. So we already know, just from this question, it's leases. Okay, with leases, you can be asked us to calculate the cash flow for lease. You can be asked to calculate the cash flow just for the buy. You can be asked to calculate the cash flow for both and to compare. So you need to make sure you understand what's being asked here. It's just the buy alternative. That's it. Okay, so second part. You have also investigated the possibility of leasing the machine and calculate the final present value to be 350,000 Rand, negative 350. Based on this, which option would you recommend and why? So here, they've already calculated the lease option and they're asking you to compare. So if I go to my formulas and we go to leases, so remember I said determine after cash flow of the lease alternative, determine after cash flow of the buy alternative, determine NPV of lease and buy, make lease or buy decision. Okay, so what is happening in this question? They're asking you to do step 2 for number 1. They've already done step 1 and part of step 3 where they calculate the NPV. That's in part 2. And so you need to then compare the two answers. Okay. So let's read the information. So it says Grubber Limited, a sports equipment manufacturing company based in South is intending to expand its output capacity by acquiring a new manufacturing machine from Japan. The new manufacturing machine will be used to meet the expected increase in demand for its main product, a scrum machine, which can be used in both indoor and outdoor training facilities. Okay, so we know, in essence, they want to understand, or they want to get in a machine. Now it's about how they're going to get up. They're going to buy or they're going to lease it. Grubber Limited could finance the 225 cost of the machine by taking out a 2-year bank loan, charging interest at 12% per annum with installments of 133,132 Rand and 8 cents, payable annually in arrears. Okay, so what is important is that when you're dealing with lease or buy decisions, we can have a financing option. If we have a financing option, it means we have to calculate or prepare an amortization table and then use the interest or capital amounts in our calculations. Okay, we can also get a buy decision where you don't finance. So it's just straight cash flow. So you need to read the question, right? In this question, they're telling you that they can get a bank loan. Therefore, we must factor that in. Okay. Then it says the current cost for insurance and maintenance per annum is 45,000 Rand, whilst the current running cost for authenticity of similar type machines has been estimated at 62,000 Rand per annum. Okay, so now they're giving us the cost. Okay, so remember, and I did say earlier that when you're doing lease and buy decisions, you're trying to determine which one will give you the lowest cost. Okay, so these are other costs that we have to factor in. As Grubber Limited has gone off-grid using solar and harvesting rainwater, water and electricity costs expected to decrease at a percentage equivalent to 1/5 of what the general inflation percentage is projected to be for the next 2 years. Okay. So now what's happening is we have to factor in inflation as well as a reduction. And this is how they can make any cash flow question difficult. We know this from previous learning units. We know this from last semester when we were doing, if you were doing financial management 3A. We can factor in inflation and make things tricky. Okay, so that's what they've done here. Then they say Grubber Limited's financial managers estimated that insurance and maintenance will increase by an additional 8% over and above the inflation rate each year. Okay, inflation is expected to be 6.25% and 8.50% for the next 2 years. Then Grubber Limited would be entitled to capital allowance deduction of 80% for year 1 and the balancing in the following year. Okay, so very key with these lease and buy decisions, tax. Okay, tax was something we covered also in 3A, but it's very prevalent in these kind of questions. And in your textbooks, they talk about a tax shield. What a tax shield is a tax benefit because we're dealing with costs. So we've got costs, we're working out what the taxes on that, and that will be a benefit. Okay. Then you've got to assume a tax rate of 27% applies, that the deductible tax cash flow relating to the lease or buy decision arises in the following year in which it accrues, and that the company has sufficient taxable income against which to apply any tax deductions arising from the buy decision. Okay, so this is very important. Your tax rate, number 1. Number 2, when do you have your deductible cash flow? So they are saying that it arises in the following year it accrues. It means that if I calculate my tax in this year, I can only get the benefit of that tax shield or tax benefit in the following year. I cannot get the benefit in the same year. Okay, so it's really, that's very important here. Okay. And the other thing is that they have sufficient taxable income against which to apply the tax deductions. Okay, because if you understand tax, you cannot take into account a loss unless you have taxable income against which to deduct it from. Okay, it's very important. Then it says Grubber Limited has a before tax cost of 11.50%. Okay, so the cost is normally the cost of capital. So this is the rule. If your cash flows are after tax, your cost of capital must be after tax. If your cash flows are before tax, your cost of capital must be before tax. They must match. Okay, so please make sure you read the question. Make sure you understand if your cost of capital that they're using is before or after, and whether your cash flows are before or after is very important. Okay, so to start with our question 1, we are going to start off with our cash flows. Okay, so there's different ways. Some people like to start with the calculations. I'm starting with the cash flows itself. Okay, there's going to be a year 1 cash flow. There's going to be a year 2 cash flow because that's what they've told us. And because of the tax, because the tax is paid in arrears, there will be a year 3 tax flow, okay? Or year 3 cash flow, not tax flow. Now I'm going to record all the amounts that exist, okay? First things first, or the first one that we have is our installments. That's how much we're paying. So that's the first thing. Okay, and installments are basically given to us. It's this amount here. Yeah. Right. The next thing we're going to note is our insurance and maintenance cost. Okay, insurance and maintenance. Right, so with insurance and maintenance, they told us it's 45,000 Rand. However, they did say to us that there is going to be an increase. So here we're doing insurance and maintenance. We know it's going to be increasing by an additional 8% over and above the inflation rate each year. And inflation is supposed to be 6.25 and 8.5. So what does that mean? Here, when we are calculating our cash flow, we take in the 45,000. Okay. We are multiplying it by the or we're increasing it by the percentage, okay, which is 1 plus we have the 6.25, which is the initial inflation, plus also we have the extra 8%. And obviously, there's different ways. I could have said 45,000 times the 6.25 plus 8%, and then add that onto the 45. I could have done it that way, but I'm not doing it that way. I've decided to do it like this. So if I do the calculation, okay. So I get 51412, comma 5. Okay, for insurance and maintenance first, right? Right. Now I'll go to the next year. Because it's inflation, I'm going to take the 51425, okay? Okay, so the inflation for the second year is 850. So please look here. They said for the second year it's 850. We know it's increasing. Okay, so if we calculate it, we're saying it's this answer. multiply gives us our 59895. And year 3, there's no cash flow. Okay, then we're going to move on to the next one. The next one is our running costs, which is our water and electricity. Okay, so with our running costs, okay, we know that the running costs are 62,000 Rand. Okay, they did say that it's going to decrease at a percentage equal to a fifth of what the general inflation percentage is projected to be for the next year. So that's how much it's going to decrease by. Okay, so it's literally going to go down. Okay. Okay, so how do I calculate it? Okay, I take my 62,000. Okay, I'm going to multiply it by a fifth because that is what it's going to decrease by. Okay, I then am going to apply the inflation rate to it. And remember, I have to factor in the increase that's been happening, so I must bring that in. Okay, so if I had to solve it, we get 14. Sorry, everyone. For 1/5, but I must not include that 8% because that was only for the insurance and maintenance. So let's make sure I don't make that mistake. Okay, much better. Okay, then we do for the following year, and because it is inflation, we must take account the amount that we calculated previously. Times it by a fifth, times it by whatever the inflation is for that year, which is the 850. So if I calculate this answer times 1, so let's just fix this because there needs to be 1/5 of this. Okay, let's just make sure it's working. I just seem to have lost connection there. I'm just trying to bring myself back. Just give me a sec. Okay, so just with the running cost, we must make sure that we are decreasing it by 1/5 of the inflation. So it's the 0.0625 times the 1/5. Okay, so we must make sure that we are actually decreasing. So the other way you could say actually is you could just go your 62,000 times 1 minus the 0.625 times 1/5. If you want to do it that way, that also works. Yeah, that's better. Okay. Right, let's go to the next one. So I must make sure here that it's right. So it's times the 1 minus. So in other words, what they're saying, it's, it should decrease at that rate. So I'm just taking it into account. 0.085 times the 1 divided by 5. So if I have to bring that in here. All right. Now let's move on to the taxation piece. Okay, so for the taxation piece, we need to do a calculation. So I'll come back there. I'm going to do a separate calculation here. Okay, so this is our after tax flow calculation. Now we're going to do our working one, which is the taxation. So with your taxation, we have to follow normal tax principles. So the first thing is your interest, which will be a deduction. That will be a separate working, which we need to do. We then have our running costs, which will be the same as what we had above, our insurance and maintenance. Then we're going to have our capital allowances because that's what's required when you're calculating tax. And that will then give us our taxable deductions. And then we will calculate our tax amount. Okay, so interest, we have to do a separate calculation. We have to do a little table. Okay, so with your interest calculation, we basically have a little amortization table, as they call it. And with our table, we basically have the year, we have the opening balance, we have the installment, We have the interest. And we have the closing balance. Okay, so we have year 0, year 1, year 2, and that's all we have. We've only got 2 years for this question, so it's pretty short. Then our opening balance will be the full cost of the loan that we take out, which is 225. Our opening balance will be the same as our closing. Our installment is the amount that they gave us, which is the 133. And we have that for 2 years. Okay, interest we have to calculate. We're going to say it's the 225 times the 12% that they told us. Okay. Then for our closing balance, we take our opening balance less our installment plus our interest gives us our closing balance. Okay. Then we do the next lot. Okay, and then for the last one, we do the same calculation. We take the opening balance plus gives us the closing. And obviously this, well, that 16 comes from that 0.8, which I hadn't included. Okay, which then gives us 0, basically, if I round this up. Cool. Okay, so now that we have our interest, I can take my interest amount from here. So if I have to color code, so you know where I'm getting my values from. Year 2. Right? Then my running costs, I'm literally going to take from here. Insurance. And then we have to do our capital allowance. They said that the capital allowance in year 1 would be 80%. So it will be our value of our asset times the 80%. And this would be the remainder. So either you can say the value, which is 225, times 20%, or you can just deduct 225 and get the full answer. Okay, which then gives us our taxable deductions. Okay, and then our taxation at 27%. Okay, I'm going to say this value times 27%. And now I have my taxation amount, which I can grab from here. And now we can do our after-tax cash flow. So what is critical is that these all are negative amounts. So we need to show them as negatives. It's no year 3. Sorry, with the tax, we need to also show it's in arrears. So actually the year 1 is 0. Year 2 would be this one. And year 3 would be this one. And like I said, we have to show that these are all costs. So for the other alternatives, I just literally will deduct it that way. Okay, so it's going to be this minus this plus all my costs. And I'm going to take away or reduce the taxation. Okay, which gives me 254. And I must remember that this is a negative value. Okay, year 2. And then my 48, which in essence, so this will be a negative amount. This will be a negative amount. And this will be a positive amount because outflows. Okay, and then we've got our answer for number 2.1. Okay, with 2.2, I'm literally going to calculate the net present value of this one. So for the leasing decision, I know that the net PV okay, is what they gave us in the answer. So it's negative 350. Okay. Okay, for our buy decision, I need to calculate the NPV. So depending what calculator you are using, I'm using the HP. So I'm going to say cash flow 0, cash flow 1, cash flow 2, cash flow 3. Okay, my cash flow 0 is 0 because there isn't anything. My cash flow 1 will be taken from here. It's a negative value. My cash flow 2 is here is a negative value. My cash flow 3 is here. It is a positive value. Okay, then I have to include my interest. My interest is the after tax, so it is 11.50 times 0.773. Okay, because I'm saying 100 less 27%. 840, and therefore when I NPV it, I will then get a value. The value should be negative because most of my cash flows are negative. And then we can compare leasing versus NPV, okay? Or leasing versus buying. So based on this, we can see that buying is cheaper. It's 330, whereas leasing is 350. So the decision would be to buy. And we'd obviously write that in. Any questions on this? Okay, so can't see the screen. I did resolve this, so hopefully it was resolved. Good, so I was having a bit of technical glitches there. Why are we subtracting from the 1? So when we are subtracting from the 1, so if I have to share my screen again. Okay, when we are subtracting from the 1, so in essence, what it says here is that the electricity cost is expected to decrease at a percentage equivalent to a fifth of what the general inflation percentage is predicted to be. So what I'm saying is I'm taking my 45, I'm multiplying it by the 4/5 of what's left over, okay, or the 62, and I'm dividing it by I'm multiplying it by whatever's left over because it's decreased by a fifth. That's why I'm minusing the 1. The other way you can do is you can say 62 times the 1/5 of this 6.25% and then deduct it from the 62. I've just done this way because it's a shortcut method. Okay, much easier to do it this way. Okay, and then Michaela, I don't know which part you're referring to. And then, yes, the 48423, let me go back. The 48423 is not negative, okay, because it's a tax shield, okay? What do I mean by that? These are all, when I do my tax calc, okay, these are all deductions, okay? It means when I'm calculating the tax, I'm basically have an amount owing to me. So it's an inflow. That's why they call it a tax shield in your textbooks. So no, the 48423 is a positive number in my cash flow. It's positive. These other numbers are negative. It's important that we understand that. Okay, so just been asked to repeat the amortization table. So I'll go through it again. So the amortization table, okay, you basically take your balance, okay, from the beginning of the year, or the balance of the amount that you're going to get funding for, which is the 225, includes the closing balance. That will then be the opening balance of the first year. This is the installment. This is the amount they said you're paying. So that is straight from the question. They have to give you that. Okay. Then the interest is basically your closing balance multiplied by the interest percentage, the 12%. Then we get an answer. The closing balance is your opening balance less your installment plus your interest. Okay. That closing balance becomes your opening balance. We then include the installment. The interest, we then take the balance times the interest percentage. And then we run our balance again, which is your opening balance minus installment plus the interest. I hope that was sufficient for you. Okay, so we've done question 2 now. Let's take one more last 5-minute break, and then we're going to do our last question for today. See you in 5 minutes. Okay, everyone, let's continue. Don't have much time left, only 20 minutes. We've got one more question. So, Blessing, just on your question, it's because of the tax. So, in that question, it specifically stated that tax is paid in arrears. You've done that in 3A, okay? Over here, well, it's not as in arrears, it's the decision arises in the following year in which it accrues. The tax cash flow arises in the following year in which it accrues. So what it's saying is, if I calculate tax for this year, it accrues or it gets only paid in the next year. That is why we're adding an extra year. Okay, it's got nothing to do with, it's the tax piece. Okay, so yes, textbook doesn't show you that, but the tax piece can be paid in the following year. You've done questions like that in 3A. So it's the same thing. It's just being continued now in 3B. Okay, so let's move on to our last question for the day. Okay, so I'm going to share my screen. We're going to do the last question of this session. Alrighty, so past paper question. This is for learning unit 7, which is mergers. Okay, so with mergers, we have a whole bunch of calculations. This one, or formulas, this one is asking to calculate the post-merger EPS for both companies. So obviously there's an acquiring and targeting company. We need to calculate the post-merger EPS. Okay. So if I go to the slide with all the formulas, let's remind ourselves of how we calculate the post-merger EPS. Okay, so here we have the post-merger EPS. We have two formulas. They have one for the targeting company and one for the acquiring company or merged company. So these are the two formulas that we're wanting to use actually when we start. And also to note, mark allocation is 20. It should take us 25 minutes. We're only doing question 3.1. And let me just clean up all of this so we can then continue. Okay. Okay, so like I said, this is what we are trying to achieve. But obviously we will go through the details and see what can be done. Okay, so it says Cody Limited, a company specializing in the manufacture of cricket bats, is considering acquiring Donny Plantations Limited that has various forestry plantations across the country supplying wood for various industries. The CEOs of both companies have asked for your assistance to calculate the various financial impacts that the merger will have. They have decided to base their decisions on an independent analysis which you can provide. Cody Limited has an EPS of 750 and a PE ratio of 18 times. Cody Limited currently has 750,000 shares in issue. So Coley is the acquiring company. Donny is the target company. Donny Limited has just declared a dividend of per share 4 Rand in line with their payout policy of 80% of earnings and a PE ratio of 12 times. The shareholders have indicated that they are only willing to accept an offer that is 20 Rand and higher than their current share price. Donny Limited currently has 90,000 shares in issue. The merger is expected to provide synergistic benefits equivalent to 30% of the combined earnings for both companies. So I know there was a question about synergistic benefits. Here it says 30% of the combined earnings. They are telling you where the synergy is impacting. Okay, very important. It doesn't have to be in earnings only. It can be in anywhere. Coley Limited's PE ratio at which the share will sell after the merger has occurred is expected to be lower than the current PE ratio by 2. Okay, so first place that we start is we have to include the formulas which we have. We're going to first calculate for the acquiring company, which is Coley. And then we also need to calculate for the target company, which is Donny. Just give me a sec to reshare. All right, so okay, we'll start off with Coley. Okay, so it is merged company EPS is our total earnings divided by your acquired company shares or acquiring company shares and your target company shares times ER. Okay, so let's look at earnings. In this question, they haven't given us the earnings. So the first thing we have to do is we have to find total earnings. Okay, so that's the first step. How do we get total earnings? So when we are calculating total earnings, we need to find a formula that will have earnings in it. Okay, so if we look at our formulas, we have this formula, EPS equals E divided by NSI. So that's what we need to use. We're going to use our EPS. Okay, we are solving for E, which is equal to your EPS times NSI. Okay, so how do we solve? It'll be your EPS for Coley, which is 750, times the number of shares in issue, which is 750. Okay, so that is our earnings for just for Coley. So remember, with total earnings, we have to calculate for Coley first. Coley. We also have to calculate it for Donny and add the two together. Okay, because total earnings is the two together. Okay. Okay, for Donny, okay, we have EPS for Donny, which they haven't given to us, and they've given us the number of shares. Okay, so to calculate Donny's limited's earnings, we need EPS. They haven't given to us. How do we calculate EPS? Okay, we can use our PE ratio. So if we use our PE ratio, the formula for PE ratio is your share price divided by your EPS. And therefore, our EPS will give us our share price divided by our share price divided by PE. Okay, we have the PE ratio for Donny 12. We don't have the share price, but we have dividends per share. So what does that mean? I've got to now use my dividends per share dividend per share formula to solve, right? Okay, so our dividend per share formula, if we know what that is, the dividends per share is normally your annual dividends divided by your number of shares, but we don't have dividends. We don't have your total dividends here. What we do have, however, is the payout ratio. So they've got a payout of 80%. So our payout ratio formula is DPO. Okay, is equal to DPS divided by EPS. Okay, so now I can calculate my EPS is equal to DPS divided by DPO. So I can say my DPS, my dividend per share is 4 Rand, and I'm going to divide it by the 80%. That gives me 5. Okay, so my earnings per share is now 5. Right. I can now come back here to calculate over here because I was saying EPS, I needed it. I calculate using my DPO. So I can now come back to here and make sure that I calculate. And our share, number of shares for Donnie is 90. So our earnings for Donnie is going to equal to 450. Okay, so now I can calculate my total earnings. Okay, so now I can say that my total earning is that amount plus this amount. 6075. Cool. Right, next thing in the formula is my acquiring company shares, which I have. It's the 90, it's the 750. I have target company shares, which is 90, but I then need to multiply my target company shares by the ER. So we have to calculate the ER. Okay, your ER, we need to remember the formula. Okay, it's your price paid per share of your target company divided by your market price of your acquiring company. Okay, so you mustn't forget that. Okay, so our price paid per share of the target company, okay, we don't know how much we paid, okay? The market price of the acquiring company, we know that the acquiring company we don't have that either. So we've got to now calculate our share price for both target and acquiring company. Okay, so it now means I've got to do my share price. How do I get my share price for my target company? So it's Coley. Okay. We can use our PE formula, which is your share price divided by your earnings per share, which means I can get my share price is equal to your PE times EPS. Okay, so my price earning ratio for Coley is 18, and my EPS is the 750. Okay, so my share price for Coley is 135. I'm now going to look at Donnie. I need the share price for Donnie. I have to use the same formula. Okay. The PE for Donnie is 12, and the earnings per share is what we calculated above, which is the 5. So we're going to use that. That gives me 60. Okay. That is my share price. Okay. I've got my price for my target company and my price for my acquiring company. All right. However, go back to the formula. Okay, so I'm now back here. Okay, to get my price paid per share of your target company. It said here that the shareholders of India, they were only willing to accept an offer that is 21 Rand higher than their current share price. Okay, so it means for me to get the price that is paid, it is the current share price of Donny, which is the 60, plus the 21. Okay. All divided by the market price of the acquiring company, which is in essence your share price. So if you have to calculate, ER is 0.6. Okay. Now we can complete the calculation. Okay, because remember the whole point was to do these two calcs. Let me also just shift down here over. It's all in the Donny column. Okay. Okay, so now we can do the formula, right? So we have the merged company or the acquiring company EPS is equal to your total earnings, which we said is the 6075123, all divided by the acquiring company shares. The acquiring company shares is 750 plus the target company shares, which we know is 450 times the ER, which is 0.6. Okay, so if I have to solve that, it is this answer, the 607, divided by this, the shares, which is the 750 plus 450 multiplied by the 0.6. Okay, so our merged company EPS actually didn't include the right one, did I did. The other thing I forgot is the synergy. Okay, so this is where we have to multiply by the synergy because they did say. I've added the wrong shares. There we go, 9.8. Cool. Now I can do my target company EPS. Okay, so my target company EPS is equal to my merged company EPS, which is a 9.82, and I'm going to times it by the 0.6, my ER. So if I have to do the answer, this times that. That gives me my 589. And I've now then answered the question. Any questions there? Okay, if there's no other questions, that's it for today. We are done. We went through learning units 5, 6, and 7. We've done an application question on 5, 6, and 7. Obviously not all the concepts, just some of the key ones. Yeah, that's it. If there's any questions, please just pop it in the chat. Otherwise, the video and all the content should be available for you tomorrow. All the best of luck with everything. And yes, thank you for attending. I really appreciate it.